Covered call ETFs. Maybe you heard of them, maybe you haven't. They could be very useful ETFs if you are an income-oriented investor like myself who really loves dividends but want a little bit more consistency, a little bit more defense in your portfolio, and of course, a little bit more yield, a little bit more income, right? My name is Adrian. Welcome back to the channel, which is all about income-oriented investing. And today, in this video, I'll introduce you to covered call ETFs. So I would like to take a quick moment to thank the sponsor of this video, BMO ETFs, a division of BMO Global Asset Management. So in this video, I will cover numerous topics related to covered call ETFs, everyone. Number one, what is a covered call? Number two, I'll give you a quick example of the mechanics of a covered call. After, I'll go over two important factors that make part of or are part of the covered call strategy. Then I'll review the pros and the cons of a covered call ETF or a covered call strategy. And lastly, I'll show you some live examples of actual covered call ETFs managed by BMO, who is the largest provider of covered call ETFs in Canada. And we'll compare those ETFs to very, very similar ETFs that hold the same stocks, the same companies, but don't use a covered call strategy. So you'll be able to see the difference. So by the time you're finished watching this video, everyone, you should have a really good understanding of what and how these ETFs work. And it should help you decide if they're a right fit for you. Let's get started. All right, everyone. So to understand how covered call ETFs work, we first need to understand what a covered call is, right? It's only logical. So in short, a covered call or a covered call strategy is really an income enhancing strategy using options. All right. So it allows you to get a little bit more income or a little bit more yield from a stock or a portfolio of stocks that you're happy to own for the long term. So how do we achieve this? Well, that's with options. So a covered call is actually one of many option strategies out there. It's actually a pretty basic, a pretty vanilla one, very common, that's been around for a really long time. Now, you know how there's a stock market, right? It's a market where stocks or shares of companies are traded every day, right? Well, there's also another market completely called the options market. So in Canada, the main stock market that we have is the TSX, right? The Toronto Stock Exchange, physically located on Bay Street, hence the nickname Bay Street. In the US, there's two major ones, right? You have the New York Stock Exchange, NYSE, physically located in New York City on Wall Street, hence the nickname Wall Street. But they also have the NASDAQ, which has, no physical location because it's all electronic, right? So the options market, everyone, in the US is actually located in Chicago, and the options market in Canada is located in my hometown in Montreal. So the options market is where options are traded, and the stock market is where shares or stocks are traded. So what the heck are options? That's probably what you're asking yourself. And how are they different from stocks? Well, when you buy shares of a stock, everyone, you acquire an ownership stake in a public company, right? And depending on the stock, you might get dividend payments and the right to vote at company meetings, of course. You can also buy a unit or a share of a fund like an ETF, which could hold many stocks, right? So options are actually derivative contracts on stocks. So when you acquire options, you're entering a contract to either buy a stock, that's a call option, or sell a stock. That's called a put option. Confused? Don't worry, many people are. And I could spend a lot of time really explaining exactly how all these options work, how call options work, put options work, but I feel there's much more value in talking about covered call ETFs specifically and how they could benefit you, as well as the pros and cons of the strategies, right? So just because you drive a car every day, it doesn't mean you know exactly how the engine, how the transmission, how the alternator works, right? The important thing is that you understand and know how to drive the car or the practical utility of the car. So the same thing really applies here, in my opinion. So as you probably already guessed, covered call ETFs deal with call options. And in this case, we are selling covered call options, or rather the ETF manager is selling them on our behalf. And they're selling them on the stocks inside the portfolio, right? The stocks that we own. So by doing this, the ETF generates additional income, which is called premiums, right? So this is where the extra income or the extra yield comes in. So a good analogy is really an insurance company, right? They collect premiums from you every month, whether it's from life insurance, car insurance, home insurance. So this is kind of what the ETF does as well, but instead of selling insurance contracts, they're selling call option contracts on stocks, right? So a call option, everyone, is an option to buy a stock at a certain price. That certain price, by the way, is called the strike price. So a quick example would be as follows, right? Let's say BMO stock is $125. We can sell a call option on that stock to another investor, let's say at $140. That would be the strike price. So usually when you sell an option, there's a contract on it. Usually it's 30 days, 60 or 60 days. So this is typically referred to as the expiry date. Okay, so what this means is that if the BMO stock price goes above $140, which is the strike price in the contract, within 30 days, for example, we would be obliged to sell the stock to that other investor at $140. Whether the stock price goes to 142, 145, 150, it really doesn't matter. As long as it's above the strike price within that contract period, 30 days, let's say, we are obliged to honor the contract and sell our shares at $140. So in this case, the option is exercised, right? It's exercised by the other investor. Now, the reason why it's called a covered call is because if we already own the BMO stock, we are covered in case the option gets exercised. As simple as that. So what happens if within the 30 days or the 60 days, BMO stock does not go over $140? Well, or it stays at $140 exactly. Well, in that case, the option expires worthless, right? This means that we get to keep our BMO shares, but we also get to keep that premium that the other investor paid us. So this is basically a win-win, right? This is actually the best case scenario for us because we made a little extra money without needing to sell our shares. So it's like car insurance, kind of, right? If you don't get into a car insurance this month, well, the insurance company still collects the premium, right? Or your payment. So if you're selling covered call options, it's like we are the insurance company, basically, and we're collecting the monthly premiums from selling those call options. So that is really the basics of how a covered call option works. This is something, by the way, you could actually do on your own individually on the stocks you own individually. All you need is options trading enabled on your online broker account, whichever account you use. But this could be very tedious and time consuming. And who really has the time to do this every month, right? By owning a covered call ETF, basically, the fund manager takes care of writing all those covered calls and generating that extra premium, those extra premiums on our behalf, basically. So it's literally really passive income here. So this means that it's pure passive income for us every single month without having to do any work. Passive income, my two favorite words in the English language. So before we get into the pros and cons of covered call ETFs, I want to discuss two important factors when it comes to the strategy around covered call ETFs. The first factor is portfolio coverage. So this simply refers to the percentage of the actual portfolio that the fund manager is writing or selling covered calls on. So if it's 50%, for example, which is actually what BMO does, this means that covered calls are only being sold on half the portfolio. Basically, the other half is untouched. So different fund managers have different strategies. Some do 33%, 25%, or some just have a dynamic approach where it's not set in stone. It could change every month. So BMO sticks with up to 50%, basically. So the second factor, that's the first one. Second factor is the moneyness of the call options written. So what the heck does this mean, the moneyness, right? Well, it's pretty simple. There's two types, everyone: out of the money and at the money, right? So remember the BMO example we talked about earlier, where the price is $125 and we're selling the call option at $140. Well, this is an out of the money call option. It's an example of an out of the money call option because it's simply higher than the stock price, right? 140, 125, 140 is higher, so it's out of the money. If the option would be sold at 125, the exact same number or at the exact stock price, that's at the money, right? It's pretty simple. So these two factors are important because you don't really want to write covered calls on too much of the portfolio, and you also don't want to be too aggressive with the moneyness of the call options because you could lose out on some capital appreciation or stock price upside when stock prices go up, right? So BMO's covered call strategy, everyone, really strikes a balance between generating extra income but also participating in the upside or share price upside when stock market goes up, right? So they write covered calls on approximately 50% of the portfolio, so only half of it, and they typically sell options 1 month or 2 months to expiry. So the contract period is pretty short because writing shorter term options provides greater flexibility to adjust options strike price more and frequently, and of course you'll capture more share price upside, right? So in terms of moneyness, the second factor, BMO only does out of the money call options. So there is always, no matter what, some share price appreciation capture. You're capturing some share price appreciation when the stock markets go up. So in short, it's a very, very balanced approach. Okay, so before we review actual examples, let's discuss the pros and cons now of covered call ETF. So when it comes to the pros, there's quite a few of them. Pro number one should be quite obvious: higher yield, right? This is pretty obvious. So you're going to get more income because of those covered calls, right? So the income that covered call ETFs generates actually has two sources of income instead of one. The dividend income, so if you're holding a basket of dividend stocks, you're still going to get the dividends from those stocks, plus the covered call premiums earned. So it's dividends, covered call premiums together, which gives you a little bit more yield than a similar ETF that only has dividend stocks that does not do covered calls. Pro number two is that you actually get less volatility and some downside protection. So essentially, you're getting more defense, right? You could say it several ways. But essentially, you're getting more protection and higher returns when the market is flat or very, very volatile, kind of like it is now, where it's going down. Basically, compared to an ETF that holds the same stuff that doesn't do covered calls. That does not sell covered calls. So this is simply because, like we discussed in the example, many of the covered calls written, if the market is flat, right, and or markets are going down, it's very, very, very unlikely that call options are going to be exercised, right? So you get to keep all your stocks, but you're generating a little bit more income. So you're getting more downside protection. You're getting less volatility with your returns, basically during a flat or a down market. So that is pro number two, what a covered call ETF, essentially more defense. It's more of a defensive strategy. Pro number three is the distributions that covered call ETFs give out, or the income that they distribute, is very tax efficient compared to other ETFs which give interest in income, for example. So those option premiums that are generated, that's what gives you that extra income. That income does not count as interest or dividends. It actually counts, or it's considered, capital gains income. So capital gains income is taxed very efficiently in Canada compared to interest income, for example. So the more tax efficient your distributions are, the more income you get to keep and the less taxes you pay on them, basically. So that is the three pros, everyone, of covered call ETFs. So in short, if we just summarize real quick, covered call ETFs are really designed for a defensive, income-oriented investor who really craves consistency, less volatility with their returns, and more cash flow, say, than a growth-oriented index ETF or even a regular dividend ETF. So they're very popular with retirees, of course, for example, who really need cash flow as a priority, right? They're prioritizing income over everything else, and they're a bit less concerned about capital appreciation or growth. They really want that cash flow and a little bit more cash flow because they're living life now to the fullest, so they want to squeeze out basically a little bit more income from their portfolio. When it comes to the downsides or the cons of covered call ETFs, well, you got to expect lower total returns over the long term, right? Because this is simply because the market goes up more than it goes down or more than it stays flat. So when there's a bull market or the stock markets are rising, there's more of a chance that your stocks will be called away, right? Or the call options will be exercised. So This is typically referred to, and you'll probably see this when you do any kind of research on covered call ETFs, limiting your upside during a strong bull market, during a bull market, right? Because call options are much more likely to be exercised where they're not likely to be exercised during a flat or a down market, right? So if you're selling call options, like the example of BMO stock is 125, you're selling call options at 130, 140. Well, if the market is flat, BMO stock price is probably not going to go higher than 125. So you're going to get to keep all that option premium. But during the bull market, it is possible that BMO stock price goes to 130, 135. So in short, it's possible and probable that over time, or the long term, covered call ETFs will have less total return. And total return, by the way, is the combination of share price return and income return. So it's probable that we will have less total return compared to a very, very similar ETF that holds the same stocks but does not use a covered call strategy. So now let's check out some live examples using BMO covered call ETFs, because BMO is actually has the largest market share when it comes to covered call ETFs. So really, they're the OGs of this type of strategy. They have 9 different covered call ETFs. So let's check out a few of them together here and compare some covered call ETFs to non-covered call ETFs. So you'll get a great understanding and put all the information that we discussed together here. All right, everyone. So the best way to learn is always to look at live examples. So that's what we're going to do. I'm on BMO's website here showing all their ETFs, and the covered call BMO ETFs are under the specialty income section here, everyone. And this is where you could see all 9 of their ETFs that use covered calls. You have 2 categories, basically region-based or sector-based, and we'll of course do a deep dive in 2 examples. So you have ZWC here, which is the BMO Canadian High Dividend Covered Call ETF. This is a regional-based one. Here's a sector-based one, the covered call Canadian Banks ETF. So this one would have the 6 Canadian banks. There's a US banks one, a technology one. So these would be other example of sector-based ones. A utilities one, so all kinds of utility stocks in here. You have one that follows the Dow Jones Industrial Average, which is an index. So this is actually an index-based covered call ETF. You have the counterpart is ZWC. You have ZWH, which covers dividend stocks in the US. You have European dividend stocks. You have one that's global. Here's another region-based one. You even have ZPay, which actually does a combination of covered calls and put options, but we won't cover that in this video. So quite a nice lineup here. And the one we're going to take a look at deep dive here is ZWC, and we're going to compare it to an ETF from BMO that has the same type of stocks or Canadian dividend stocks, but doesn't write covered calls on it. So we'll make the comparison. So let's check out ZWC together, everyone, in detail. So just like the name says, this ETF is going to hold blue chip dividend stocks in Canada, right? So if you look at the overview, and you guys need to always look at the fund's official website when you're making research or doing research on any ETFs, because you'll get a lot of information just in the summary, in the description. So let's go through the description together here for ZWC. So BMO Canadian High Dividend Covered Call ETF has been designed to provide exposure to a dividend-focused portfolio while earning call option premium. So that is the covered call writing. And it gives us a bit of details on, the stocks they select, that it's diversified across sector. And you see here the ETF also dynamically writes covered call options. The call options are written out of the money. So now you know exactly what this means, and selected based on analyzing the options available premium. And check this out, everyone. Here is where the defense comes in, like we talked about earlier in the pros covered call ETFs. The option premium provides limited downside protection. So there you go right there, defensive. So fund benefits designed for investors looking for higher income, of course, from equity portfolios or stock portfolios. Invest in a diversified portfolio of high dividend Canadian companies. And here's another line which talks about the defense. Call option writing reduces volatility. So there you have it. Reduces volatility, limited downside protection. You could say it any way you want, but it gives you a little bit more defense in your portfolio. So this is actually a very popular covered call ETF. It has over 1.5 billion in assets under management. So it's very big. The first thing you'll notice is a nice high dividend yield annualized here of 6.8. It's actually a bit higher now, I believe, because this is the number based on August 31st. So a really nice annual yield here. And if we look at the management expense ratio, which is the management fee and all costs of the ETF, it's 0.72. So this is ZWC. What kind of stocks are in ZWC? Well, like the name says, we could expect Canadian dividend stocks, right? So if you click on holdings, we'll be able to see that. And there won't be any surprises, everyone. Here's Royal Bank of Canada, CNR, Manulife, Enbridge, TD, CIBC, Bell, Bank of Nova Scotia. Here's an energy company, Canadian Natural Resources, TELUS, Bank of Montreal, et cetera, et cetera. So these are really the vanilla and standard blue chip dividend stocks in Canada, the ones everyone wants access to, right? These are the best companies in Canada that give nice dividends. So very, very, safe and blue chip companies here. And it's very interesting because if you scroll down, besides seeing all the stocks, you could actually see the covered calls that they're writing. So the covered calls that they're writing are actually listed here. I found that's very interesting. And now that you should understand covered calls, you'll even understand what this means. So let's take an example of this call here that they've written on Loblaw stock. And you could see here that there's a date, 16th of September, 2022. I'm pretty sure that this is the expiry date and of the contract. And you actually see the call strike price of $130. So that means if Loblaws does not go over $130 as of 16th of September, the option will expire worthless. So we get to keep our Loblaw stock. Or the fund rather gets to keep the Loblaw stock, but also generates or gets to keep that premium. So if we look at Loblaw stock, as of today, I'm filming this at the end of September 14th, it's $114. So not even close to the $130 strike price. So this is a good example of an out of the money call, right? It's way above the Loblaw's price. It's out of the money, and it's probably going to expire worthless, right? And that's typical when stock prices are flat or they're going down. It's very, very, very low chance that if it's a bad stock market period, kind of like we're having now, that Loblaw stock is going to go above $130, right? So this is where covered call ETFs shine. They shine during flat and downward market. So what could we compare this ETF to? Well, we could compare it to pretty much an exact ETF that holds very, very similar companies, but does not write covered calls. And that would be ZDV. So ZDV is simply the BMO Canadian Dividend ETF. So it has the same kind of stocks, the same kind of dividend stocks. If you go on holdings, you'll see pretty much the same stocks here. So Canadian dividend stocks, but without the covered calls. So what's the major difference? Well, the first thing you'll notice is that the yield is a lot lower in this one, right? So that's the power of the covered calls. You're getting, and of course, keep in mind, this is as of August 31st, only 4.33% yield, whereas ZWC, you're getting 6.8, so it's almost 3% more. However, I do need to point out that ZDV does have a lower management expense ratio, so that will always be a kind of a disadvantage of covered call ETFs. They're more time consuming to manage, so the management expense ratio is a bit higher. It's only normal, right? So if we look at the performance now of these two ETFs, so if you just click price and performance and scroll down, if you look at the annualized performance since inception on an annualized basis, it's 4.69% with ZWC here, but ZDV is going to be higher. It's at 7.14. So this is what I was discussing earlier. The cons is that typically with two ETFs that have the similar stocks, but one is writing covered calls, one is not, the one that's not writing covered calls is typically going to have higher total returns over the long term. This is simply because the market goes up more than it stays flat or goes down. So you need to expect a lower total return over time. Where the covered call strategy shines is it gives you more income. So if you don't really mind the total return over time, and you're more concerned with defense, number one, and number two, more income. You want to have more income now rather than a bit more total return later. Well, covered call ETFs are definitely for you. So we'll see another example. So this is a regional ETF, right? It's pretty much has Canadian dividend stocks, but let's check out a sector one using the BMO ETF comparison tool, which is a pretty cool tool you could use to compare different BMO ETFs. And what we'll do is we'll compare the biggest covered call ETF that BMO has, ZWB or ZWB. So this ETF is the BMO Covered Call Canadian Banks ETF. So it has the big 6 Canadian banks with covered calls, and we'll compare it to an ETF that has the same exact stocks, the 6 banks, without the covered calls. That would be ZEB. So let's check out the fund information here side by side. Pretty cool tool here. And you'll notice one thing right away. Again, the MER, the management expense ratio, is going to be higher with the covered call one than a non-covered call. And by the way, the MER difference, that it's higher with the covered calls one, this is a factor of why it has less total return as well. Don't forget that plays a part, right? So once again, if we look at the fund data, if we compare the yield, covered call one's always going to have more yield, right, compared to the same thing. So you're making almost 3% yield more every year with the covered call one compared with the non-covered call one. But if we look at the performance, and you could probably already have guessed it since inception here, you're going to have lower returns, or total returns rather, on an annualized basis with a covered call one compared with a non-covered call one. Here it's a little over 2% difference a year. So that's essentially the difference between a covered call ETF and a non-covered call ETF. It's really, they hold the same companies. Don't forget, you're investing in the same companies, but one is generating more income with the covered calls, one isn't. So you're squeezing out more yield or more income now, but getting a little bit less total return later. That's basically what it's all about, everyone. And like we saw, they have quite a few of them here. These are all their covered calls under the specialty income tab. And there's this report here that BMO provided me. I found it very interesting. So here you could actually see a little bit more information where you remember the 2 factors that we discussed of the covered call strategy. The first factor is what percentage of the portfolio do they actually write covered calls on? This would be it here. And BMO does it on up to 50%. Sometimes it's a tiny bit higher here, but it's pretty much their target is 50%. And the second factor is right here, the percentage out of the money. So this would be the moneyness of those call options. And you could see they're all out of the money, 4% out of the money on average, 4.73. Sometimes they're a bit higher, right? It really depends. And you could actually see the yield that's generated by those covered calls. So ZWC, for example, just the dividend yield of the stocks inside gives you a yield of 4.14. But writing those covered call options gives you an additional 3.56. So you're getting a total yield of 7.69. So this is where the advantage is, because you have 2 sources of income instead of 1. You have the dividends and you have the option premium. So you combine them together, and that's why you get these really, really nice yields. So I hope you guys really understand now the basics of the covered call ETFs, how they work. And if you want more information, on my channel, I have a great 50-minute video where I speak to Danielle Neziel, who's VP at BMO ETFs, and Chris Heeks. Chris Heeks is the guy who actually writes the covered calls and manages the BMO Covered Call ETF. So, I can't think of anyone better to speak to and ask questions than Chris Heeks. And we have amazing conversations here for almost an hour. We talk about everything that has to do with covered calls. It's a great Q&A video. I strongly suggest you check it out. You see all the answers and questions, all the topics we talk about here. And if another video I want to share with you, and I also suggest you to look at, and if you want more information, is this video here on the ETF Market Insights channel, Spring into ETF Investing Special Edition. And I am actually the guest host here. There's my picture right there on episode 1, where again, this whole episode is about covered call ETFs. I talked to Chris Heeks again about covered call ETFs. But what's also cool is that Richard Ho, this guy here, which I had the pleasure of meeting in Montreal, he works at the options exchange in Montreal. So this guy knows everything there is to know about options, right? So we have a really, really nice discussion again about covered calls in general, for who they're designed for, how they work, etc. So really cool 2 videos I strongly suggest you check out. But hopefully by now you have a really, really good understanding of how covered call ETFs work. And of course, remember, you could always check them out in detail, the entire lineup that BMO has, and you could use their comparison tool to compare them. A really, really cool tool I suggest you check out as well. Thank you so much for watching, everyone. I really appreciate it. Don't forget to hit that thumbs up button, that like button, and make sure you're subscribed not to miss out on my future content. Of course, hit that little bell next to the subscribe button so you're notified for any new content that comes out. Also, make sure to visit our website, passiveincomeinvesting.ca. If ever you want something more personalized with us, you could follow us on Instagram. That's where we post more personal things on our adventures here in Panama. So follow us on Instagram if you want. And how do I always leave you? Continue to stay safe, continue to stay healthy, and of course, stay passive. See you next time.